Good afternoon and welcome to the Coinbase Institutional Markets Call. We are still in July. It is hot here in New York and we have had a lot going on in the last week, which we're going to be taking you through today. We have David Hahn back from Europe, where I think it's also probably pretty hot. David, how was it? How was ETC? Looking forward to hearing more about it later.
Europe was incredible. Not too hot, honestly. I think summer in Europe is absolutely perfect. You have long daylight hours, not too humid, except for the sudden rains that happened once or twice. But overall, it was a fantastic experience.
Wow, I feel like you've got a much better side of it than me. Like when I was back in London, it felt like summer never really came. You might get like 3 or 4 days. So here in New York, I don't mind it being stiflingly hot. At least you kind of get some sun and you get an opportunity to put sun cream on, which in the UK you don't always get.
That's fair.
Yeah,
never gets really hot there.
Yeah, very good. Well, great to have you back. Haircut looks sharp too. Don't know if that was a barber in Brussels, but who knows?
Thanks. We're still back in New York.
Very good, very good. So we got a lot on today. So David's going to take us through ECC. We're also going to go through a market outlook, running through ETF updates, and then also political updates. Some really big changes there. And then also the macro with the recent inflation data as well, and updates on rate cuts. So a lot to cover. We're going to get right into it. But before we do, if you're watching on YouTube, don't forget to scan the QR code to access all the team's fantastic research. If you are listening on a podcasting platform, don't forget to like and subscribe so you can get an alert when our new podcasts come out. But without further ado, let's get right into it. We were in around the 55, 60, 56K last week. We're now trading up above 63 and we've been up above 64 post the weekend's news. Josh, welcome back. Great to have you with us again. Can you give us a bit of a rundown on what has been happening that has moved the markets quite so drastically?
Yeah, it's a loaded question. One, it's great to be back here with you all. There's obviously so much that's happening last week. It really was an interesting one, right? I think looking back at price action, it was actually, as you're just indicating, relatively muted with prices staying between 56 and 58K in BTC. Really on the week, there were well-flagged headline risks that continue to be there, with ongoing fears around the prospect of large liquidations of BTC internationally, including large BTC wallet movements by the German government. That's, of course, been ongoing, well-flagged. But in general, it led to a poor setup in a usually seasonally strong July. Disappointingly as well, we also had a strong macro data beat on Thursday that resulted in a muted response across risk assets. Generally speaking, crypto was not immune. And it was disappointing because looking at BTC's response to inflation data specifically, usually inflation beats result typically in gaps higher, including the June reading when BTC closed up 1.6%. Due to inflation coming in lower than expected. Unfortunately, though, we obviously didn't see the same trend on that Thursday. I know David has more thoughts on this one, but whether this was like really an equity risk asset driven trading day where equities also disappointed and thus crypto did, I'm not sure, but I think it was generally quite disappointing to see prices barely move last week.
Okay, so let's dig into a couple of those things quickly. So German government, they are, I believe, they finished selling now. And if we kind of look on the chart, where they kind of finished versus where the market is, they unfortunately were somewhere closer to the bottom, kind of where they finished. Mount Gox distributions, we covered those last week. I think, was it David? Is it 2 of the 5 exchanges have already distributed, and then we're still waiting for the other 3, and it could be anything from 60 to 90 days. Is that right, David?
Yeah, but we're beginning new headlines that suggest that even though some of the exchanges said that they would pay out immediately, even some of the exchanges that suggest that they could take up to a maximum of 90 days are apparently sending letters out that are telling people that they could actually receive their Bitcoin within the next 7 to 14 days.
Interesting. So we've still got that as an overhang that people are keeping an eye on. It's funny, speaking to clients, people are talking about the Genesis wallets now as wallets to keep an eye on, even though 97% of that is going to be delivered in kind. David, just while we've got you here, on the inflation side of things, can you kind of run us through that in a bit more detail, what that means and how people are thinking about rate cuts going forwards as a result?
Yeah, so inflation came in slightly under expectations, but I think more important is that supercore inflation, which has been closely watched by a lot of Fed pundits and people who are like trying to figure out what the Fed's going to do, it was actually down for the 2nd straight month. So we're getting this kind of scenario of like softer inflation. The economy has still been doing okay, even though, as we mentioned last week, that unemployment rate came in slightly higher than expected. The last reading with the non-farm payroll, so it came in at, I believe, 4.1%. It still kind of raised this question of like, well, why did the market suffer? I posited that maybe it's potentially a buy the rumor, sell the fact situation, where we did see that markets performed well into the CPI reading, and then it subsequently kind of sold off. I'll be honest with you, I brought that idea up to a few clients, and I think the reaction to it was unsatisfactory. So I've had to kind of revise things a little bit. I do think that there could be something else in here. We also saw that the spread between the CPI and the PPI actually also potentially made the idea of earnings growth less attractive, because typically when you see the spread between the producer price index, the PPI, and the CPI, the consumer price index, actually start to move, that tends to be an economic indicator that helps gauge the profitability of businesses. So that's the one potential reason why it might have happened, particularly given the fact that earnings season also just kicked off.
Perfect. And looking at the Fed Fund futures, what are we pricing in now through to the end of the?
So it seems that the Fed Fund futures are now pricing in 2 rate cuts for the year.
Oh, no.
So before it was like a 70, 80% chance that the Fed would cut rates starting in September. Now that's fully priced in. I do think that the wider implications that we've seen in terms of the U.S. elections can also kind of feed into that idea. But we also got Powell's testimony last week in front of Congress. He also had a interview this week. He seems to be a lot more lenient towards the idea of rate cuts as well.
Very good. Okay, well, that's certainly a good longer-term catalyst for the space, which is awesome. Also, looking back last week, Josh, ETF inflows actually looked pretty positive. What was going on there?
Yeah, so I think, let me just pull it up again, but looking at the ETF inflows, the ETFs in total saw, I think, over $1 billion worth of inflows net last week, which of course continues to speak to the strength of those flows. And those flows are led, I believe, by BlackRock as well as the Fidelity funds. In general, on the flow side of things, crypto investment products were said to have seen $1.4 billion in net inflows across the entire week, and that's per coin shares. Of course, BTC leading the charge there, unsurprisingly so. But ETH products are also added about $72 million on the week. So the flows in general, to me, look truly astounding. It demonstrates that even when prices are underperforming, that participation is quite robust. And I think that just demonstrates, again, positive sentiment to be seen in the fact that during a pretty abysmal week of price action, the flows are still positive.
Yeah, I have to agree. I felt like it was actually pretty encouraging that we didn't see any real outflows. We were trading down at 55, 56K, and there weren't kind of outflows from IBIT, and certainly not large outflows across the board, which is hopefully meaning that the RIAs are getting people into these positions for a longer period of time as opposed to a short-term trade. Now, David, we have the ETH ETF. We heard from Eric Balchunas yesterday. It sounds like it could be next Tuesday by the sounds of it. Any updates there, especially as the market's ticked higher?
No, I mean, this is just suggesting that the final S1s are coming in, and that's the rationale behind why July 23rd has now been posited as the deadline for when these ETFs are going to launch. But I would say that overall, the sentiment hasn't changed with regards to the ETF potential flows. Expectations are still fairly weak. I think the range is still somewhere around the $1 billion to $3 billion range. I think that this is actually not a bad place to be, because it means that the potential to surprise to the upside actually is there.
Love it. You've certainly been a bull on this one, which is good. How about Solana ETFs? How are we feeling there?
It's interesting because we saw that some Solana 19B4s have been filed, which now sets a formal March 2025 deadline. I think previously, they were kind of put in, but you need both the 19B4s as well as S1 filings in order to kind of make these officials, and only the 19B4s actually have a deadline actually attached to them, which would start the clock for the full length of 240 days. So I think that a lot of that's still contingent, though, on the regulatory environment and whether it would shift, because as most of our listeners probably know, we have seen that the SEC has in the past been fairly disparaging putting Solana on the potential security list.
Yeah, well, certainly one to keep an eye on. It's encouraging these people are putting these, filing these 19B4s, but we'll see how they work out. Now, we also mentioned at the top of the show, we're now a few minutes in and we haven't brought up the attempted assassination of former President Trump. Post that, the market moved higher very, very aggressively, and Polymarket odds went from 59 to north of 70% for him to be re-elected as president. I guess, guys, how are we thinking about this? This was a super, super strong move. We've then also seen JD Vance announce as his VP, who's pro-crypto. Does this mean that the outlook for crypto in general, from a legislative perspective and regulatory perspective, could be far more positive? And is that why the market's rallying?
I could start, and then I'd love to hear David's on this. But I think in general, taking a read on the market, it would indicate that, yes, that the market is seeing that with a Trump presidency, especially with expectations around potentially less regulatory oversight, potentially, potentially a lower rate environment, just in general, that risk assets like crypto should outperform. I think what's interesting here is that there are various different narratives around crypto price action, whether that's interest rate driven, monetary policy driven, or regulatory driven. I think there's many different facets of what kind of the narratives around what drives price action. I think what's interesting here is that I read somewhere that said that actually a Trump presidency could actually be bad for inflation because some of the proposed tax cuts, as well as government spending, as well as some of the tariffs that are being proposed, could just in general lead to a higher for longer narrative. So really, I think what's interesting here is how do these various different competing narratives result in BTC? How does that impact BTC's price action? Will it be the dominant narrative that a crypto-friendly candidate from a regulatory perspective is good for the ecosystem, even in a higher for longer rate environment? I think, to me, that's something that I'm really watching. But in general, it's obvious to me that taking a look at price action since Saturday, this is an asset that's moved up 12% in the last 3 days. It's running through 62K. I think seemingly the market is loving the idea of potentially a Trump presidency. That's how I see it.
Yeah, I think the first order reaction is going to be, well, what does Trump represent for a crypto regulatory environment? And, we saw that, I think now it was 2 weeks ago when the Supreme Court overturned the Chevron deference ruling, that effectively that did very little for markets because we couldn't really suss out, well, how is this going to change things? What happens now that the executive agencies don't have as much power, the courts do, blah, blah. Whereas this is very, very clear that this is a positive for the regulatory environment. And if you're, say, a holder of you're one of the claimants to the Mt. Gox Rehabilitation Trust, for example, and you're getting repaid your Bitcoin, are you willing to sell into a market where in 5 months the entire regulatory situation in the U.S. could change? Or are you going to hold it? I mean, you've waited, for example, 12 years in order to get paid back. And now you're going to try to sell right before something this massive could actually happen. I think things like that are definitely feeding into the market. People now just kind of changing the odds, not just of the crypto situation writ large, but just even the micro kind of technical developments that we're seeing on the supply demand side of things. But to Josh's point, yeah, there's going to be this other math that has to be done if we did see that there was going to be a Republican controlled House and executive, things could actually change as far as inflation. We're not sure what the wider implications would be in terms of how the fiscal situation could actually exacerbate inflation, for example. My guess is that would probably be good for steepeners. So there's going to be a lot of talk about the short bond trade, for example, versus long alternatives. But I think that still the concern is that we're going to get tariffs, we're going to get other things that could impact the economy. But also, the first initial effect of it might be that we'll get a strong dollar because we're going to get this red wave. Typically, when you get a strong dollar, it doesn't do so well for crypto. Then you're going to have to think about, if we are inflationary, for example, does Bitcoin still operate as an inflation hedge, or will it trade more as a risk asset alongside stocks and other things? So I think that there's going to be a lot of considerations that people are going to have to make. after the fact, after the first order effects that we're currently talking about.
David, I'm just curious though, do you think, I guess, based on what you just said right now, do you expect Bitcoin to trade more like a risk on asset or to act more as an inflation hedge? Because I think that these two things can potentially compete with one another. What do you expect?
The first thing I would say is that I don't think they would compete with each other. I do think that what I like about Bitcoin in this environment is that either scenario works for it. If it starts trading more in line with, as a risk asset, along with other long duration assets like stocks, for example, that benefit from higher rates on the long end, for example, then so be it. And I think Bitcoin could do quite well. But alternatively, if we're looking for a replacement as a safe haven against the idea of inflation could actually go higher due to some of these fiscal impacts, for example, equally, I think that Bitcoin looks very attractive. And we've seen that already it's kind of supplanted gold in some ways, not fully, but it's acted more and more as an alternative safe haven asset for a lot of people. I think that could be also very attractive for it. So I think that, to be honest with you, something like Bitcoin kind of wins either way.
It's interesting. Larry Fink was on TV yesterday, kind of talking about the values of Bitcoin, and it's amazing kind of the 180 that he's done, and just having the power of having someone in his position talk about it in a similar way to you just did there, David, is incredible. And I guess one of the date for your diary, folks, 25th, 27th of July, Bitcoin 2024, Trump will be speaking. So if you want to make the flight to Nashville, then you can kind of hear all about the future of Bitcoin mining and everything like that, if his previous conferences have been believed. But I guess I want to move on to JD Vance now as well. So obviously his VP nomination came out late yesterday. He is known to be pro-crypto, known to own crypto. He's 39. It feels like that could be incredibly positive for the space as well. Someone that is probably a little more up to speed with financial infrastructure and how crypto and the technology as well as just Bitcoin can help more broadly. I'm curious. Let's start with you, maybe, David. How are you kind of thinking about that?
Yeah, I think given his background, because he used to work in VC in San Francisco, for example, and we know that his funding for his past campaigns have come from the likes of Peter Thiel, for example. He knows Mark Andreessen. I think all of that kind of speaks to someone who's a lot more technology forward than some of the candidates we may have seen in the past. And of course, given that this whole election cycle has been about, well, not all of it, but a lot of it has been about age and who we want to see in charge for the next 4 years. I think the fact that this is a young person, or relatively speaking, a relatively young candidate who is, a lot more inclined towards technology, I think will be a huge factor in this election.
Yeah, I mean, what a breath of fresh air to have somebody who's got a 3 handle. He's 39 years old. It's this guy is he's a young guy. And I think, Ben, to your point, I actually didn't think about that too much, but that is actually, I think, critical. And I think something that a lot of people heading into this election are focused on is who's the ticket and how old or how representative are these candidates to our generation. And I think that really is quite an important factor. I think in general, when it comes to JD Vance, it sounds like he wrote a pro-crypto, what was perceived as being a pro-crypto bill, primarily because I think it had maybe sought to bring clearer legislation with respect to the competing different agencies that try and regulate crypto, which I think any clarity there would of course be, I think, very well received from our business. I think in general, though, JD Vance probably has, from my take, a little bit more ideological roots than fundamentally pro-crypto roots. In general, he's probably a candidate that's much more anti-regulatory than potentially pro-crypto. So having said that, I still think that if the narrative is going to be dominant, that having a pro-crypto or rather a not anti-crypto candidate in office, then I think JD will be potentially great for our business. And it'll be, time will tell to see, the devil's in those details, of course, with what exactly it is how he wants to regulate our business. But, I think it's a great start.
I have no doubt that every conference organizer in crypto probably emailed his team yesterday and said, will you come and speak? One thing that I reflected on when I saw his age, 39, I was like, oh, wow. I think it's the first time a presidential candidate has been younger than me. I was like, suddenly I'm feeling a little bit old, but, I'll get over that.
I watched his movie last night too. Like, if there was a way to like bet on how many people are like watching Hillbilly Elegy on Netflix, I wanna get in on that.
I might even try and find some time to watch that now, David. My wife read the book and recommended it, but I didn't get around to it. Although actually, you know what? I think I listened to it when I had my first, and I was half asleep, so I didn't really take much in, to be honest. But so I might need to revisit that. Anyway, we'll see how this plays out, but certainly potentially very positive for the space, and we'll see how the election turns out later on this year. But let's move on to ETHCC. David Hahn, welcome back. Looking great with a very sharp haircut. Hopefully you didn't consume too many mussels and baguettes when you were in Europe. But how was ETHCC?
Yeah, thanks. Brussels was great. The city for an American, it's very beautiful, very historic. But I guess a lot of European cities are like that. But yeah, there's a lot of takeaways at the conference. A lot of very interesting panels, a lot of very interesting side events. I think there were a lot of side events relative to the main event that just kind of drew attention everywhere. But I guess I'll kind of go down and just kind of go over all of my main takeaways, of which there were quite a number. I think the biggest takeaway, though, out of everything, just kind of the high level thing, is a general sentiment that Ethereum needs to kind of redouble down on consumer applications and improving the user experience, whether through account abstraction, better scalability, etc. That said, there's still a very strong investor base on the infrastructure side, which seems to have peaked somewhat. Some of the recent airdrops on a lot of these infra plays have kind of underperformed the market, and there's kind of this rotation towards, hey, we need to kind of improve our consumer user experience, particularly after Solana's release of Blinks and some of the stuff that they're doing on that side. There's really this sense of urgency to improve how non-crypto users actually onboard into crypto.
And David, just to jump in there, like, what were some of the ideas or new projects that people were thinking through to help there?
I think the biggest one is account abstraction. I know that this has been talked about quite a bit, but account abstraction historically has had a lot of challenges. So just because you can onboard people into a smart wallet doesn't mean you get to make use of all these beneficial features. For example, transaction bundling, right? Like today, if you go to Uniswap, you need to approve a transaction and then sign it. Theoretically, with smart wallets, you can just group all these things together. There's another technology called session keys where you can just say, hey, I want to automatically sign all transactions for the certain application over a certain time frame. So you just sign once, and then you can just do trading or gaming without re-signing for the entirety of that session. And I think that a lot of these technologies require integration on the application side. So it requires Uniswap to kind of integrate this stuff. It requires these schemes to integrate this stuff. And there hasn't really been this big push to use these AA toolings, account abstraction toolings. Now I feel like a lot of the panels I've talked to, a lot of the teams I've talked to, they're just like, hey, actually I realize the importance of this. We're looking to not only integrate existing current wallet integrations, but we're also looking to integrate some of these more, complicated technologies for account abstraction.
So David, I think that over the course of the cycle, we've seen a strong focus on layer twos. And there's been, of course, a lot of discussions around layer two scaling, differentiation. Was there any conversations that you saw around the relationship between Ethereum's layer one as a settlement layer and the various L2 platforms that are evolving right now?
Yeah, definitely. L2s were another very big topic of discussion. A lot of side events were hosted by different L2s. Vitalik in his keynote talk, he pretty much reaffirmed Ethereum's direction as the settlement layer for L2s, and that Ethereum as an ecosystem should be focusing really on our data availability layers and other sorts of tools that just improve or make L2's lives easier for developing. That said, the L2s have been differentiating a lot. I attended a few panels, and the technology itself is also differentiating. So, you're having not just the EVM, you're having Arbitrum Stylus. They're pushing like Rust, C, C++ integrations into the EVM. Starknet is doing their own thing with the Cairo VM. There's a lot of activity on other sorts of virtual machines based on different L2s, as well as just super scaling of the EVM. So there's a lot of discussions going on about L2 scaling. That said, that's promising, by the way. So I think that's really cool. It gives developers more opportunities to kind of pick and choose their technological trade-offs, right? Because there's no best technology. It's what do you do at a cost of another. So that's been great. That said, there's also been some new challenges that are posed. For example, one thing that didn't seem to have any clear solution is the EVM itself. So the EVM currently really gets one update a year on the Ethereum mainnet. But these L2s, because they're a bit more centralized, they iterate a lot faster compared to Ethereum. And so some of them might want to say, hey, there's this EIPs that are being discussed on Ethereum. We think they're great. We just want to include them right now into our EVM. And maybe one L2 will do that. Another one might think another EIP is great. Another one might actually want to remove a feature or add new features. And so what happens once you have a bunch of different types of EVMs, and it becomes a lot more complicated for developers to navigate this space. That said, that's still probably at least a year out into the future, but that's something that also needs to be considered. Is how do you do L2 governance across these L2 chains? So that's something that is both good and bad about these L2s. The technological diversification is good, but the governance and cooperation is quite challenging.
Was there like a clear answer around if ETH is purely a settlement layer, I guess like how the value accrues to ETH and how you would value ETH going forwards?
Yeah, this is something else that was, I guess, discussed. On the one hand, ETH is going to be a settlement layer in the short term. I think the long-term vision, at least in Vitalik's roadmap, is make ETH better for L2s, make Ethereum mainnet better for L2s, make Ethereum mainnet even better for L2s, and in the future, kind of refocus on the L1 scaling picture. But that's kind of far off in the future. And then I actually was part of some very interesting debates around whether or not L2s are extractive to ETH, because these sequencers get to capture a lot of the profits, right? So all these L2 fees, a lot of them are paid in ETH, but not all that is being paid to the L1, right? So not as much ETH is burned, and then these L2 sequencers get a lot of ETH essentially holdings. And the question becomes, what do these sequencers do with that ETH value that they capture, right? And really the question of whether or not L2s are extractive or not extractive to ETH comes down to what happens to the ETH that's held by the sequencers. On the one hand, some think that the sequencers are just going to sell all their ETH for US dollars or whatever other currencies, Bitcoin, just to fund their operation costs or diversify the treasuries. Others think that they might hold more ETH just because they want to be Ethereum aligned. And when you're within Ethereum, ETH is the most powerful asset just because of the counterparty risk assumptions there. I lean towards the latter camp, where I think that a good portion of the sequencer fees are going to be retained in ETH, insofar as just being on Ethereum, you want to have ETH just in case there's changes to the ecosystem. Maybe you want to have more funding. Maybe you want to add liquidity to your own L2 governance tokens. I think ETH is just a very powerful tool. That said, it's not. So there might be some extraction where some ETH is being sold for US dollars rather than being burned, but it's not a purely extractive parasitic relationship like some make it out to be.
I think that the conversation you were kind of talking about with L2s and the EVMs is really interesting. You wrote about the takeaways from ETC and this week's weekly market commentary, but you also kind of talked about interoperability between the different L2s. And I know that this remains a contentious issue in the ecosystem, and there doesn't seem to be a real clear winner. Privately, we have a conversation about this, and you seem a little bit disparaging about it. But what do you think are the biggest challenges to actually achieving full interoperability? And is this what you think we need to be focused on right now?
Yeah, definitely. So one thing about technology is that technology is very, very rarely is there like a best technology. I mentioned this earlier with L2s, is that a lot of technologies have different trade-offs. And at the end of the day, it's a question of what use case are you trying to solve for, right? Are you trying to minimize trust? Are you trying to maximize speed? Are you trying to maximize throughput, et cetera? And all these things have some sort of trade-off. Might not be a one-to-one trade-off, but there might be a better technology might have fewer trade-offs. Interoperability, I feel like we've hit a point in the ecosystem where a lot of these technologies are feasible, right? So if everyone were to come to an agreement and say, hey, we're all going to use technology A, perfectly fine, and everyone develops on that, and then we can move forward very quickly. The problem I feel like with interoperability is that there's a lot of vested interest in a lot of protocols who all want to be that one standard. And when I was there was a lot of talks, a lot of panels, a lot of discussions about different types of interoperability protocols who all want to be the standard. And there doesn't really seem to be very much room for compromise, just given the way that these protocols are set up, right? They're all their own independent networks of some sort. Maybe they have some sort of financial tokens attached to them. And then it seems very hard for them to kind of coalesce and compromise on terms of standards. And I think a reasonable analogy would actually be looking back to the internet protocol. I think, a lot of people talk about TCP and how that came up. What most people don't realize is that during the 80s and 90s, there was actually quite a bit of discussion around, what should be the networking protocol. There was a lot of debating protocols or debating standards at the time. And the reason why TCP won out was because TCP was the one that was used for ARPANET, which was the foundation for the current internet. So really the reason why TCP became the standard is because the internet, which was built on TCP, took off. And maybe we'll see something similar where certain cross-chain applications that use a specific standard take off. And then that becomes the default standard because everyone already uses it. But I don't think that we'll hit that point for some time, just given how I feel like how segregated all these cross-chain applications are today in the space.
A lot of people spoke about applications and lack thereof. Is that fair? Were there kind of things that could bring the next 10 million, 100 million people into crypto that you saw, or was it still very much infra related?
I think there were the main things that I saw that could bring the next 10 to 100 million people into crypto are, I mentioned the account abstraction and smart wallets. I know Coinbase has our own smart wallet that we have. I think that's really the easiest way to get people on board, is just not having to worry about seed phrases, not having to worry about paying for gas. A lot of these paymaster solutions where essentially as a consumer user of an application, you don't need to actually pay the fees. Someone else will pay that for you, because theoretically you might provide more value through the other activities that you do on that application. So I think that that's really the most promising thing I saw.
Were there any end user applications though? Obviously account abstraction helps you on board, it helps you get up to speed and reduces the friction, but like the friction to do what? Is there anything at the end where you could, whether it's Farcaster for social, or we're seeing a ton in the Ton ecosystem, kind of crazy, silly games, but like people are using them. Was there any like any games or any applications like Blackbird, I guess, is another example where we're kind of bringing Web 2 people into Web 3 and they don't know about it?
Yeah, there were a number of applications. There were some games around there, but nothing honestly that I thought would become like super huge. I think they're very much focused on their own niches. So it's not like, hey, we're going to compete with, I think Farcaster has a very ambitious vision where like, hey, we're going to be a social media platform. That thing will balloon. But for example, something like Blackbird is kind of like very focused on like the dining experience. So I did see a number of applications that were very, very niche industry focused. The good ones that I thought were the ones that didn't even have a very strong crypto component, so to speak. They used crypto as more of a technology rather than like, hey, we're shoving down this technology for the users, rather than saying, hey, the users have a problem. Crypto is a technological solution to that problem. I mean, coming from that perspective. So I feel like there were some things there, but nothing that I feel like would be, like a unicorn kind of valuation in the near future. So I think they're still quite small and gimmicky right now. And I think that part of that's also because this tooling and technology around smart accounts and account abstraction is really only starting to pick up steam. So we're still in the tail end of the infra phase and only starting to move into the consumer app. So I would figure probably in the next 6 months, we might see more and more good crypto UX apps starting to spring up.
I feel like this is the conversation we keep having in crypto. And like, this is, I think, a good conversation to have, especially as we're starting to think about competing ecosystems, Solana versus Ethereum, for example. But I think we keep going back to some of the main topics. And I know that a big issue at the conference had to do a lot with like staking, for example, which I feel like we talk about forever. But it's the staking ratio, concerns around like solo stakers, the centralization of liquid staking tokens, for example. I mean, what do you think issues like that are having on the future of staking in general, but really on the broader Ethereum ecosystem and how it competes with other ecosystems like Solana, like, what have you?
Yeah, that's a great question. Because there was quite a number of panels I attended and discussions I was part of around staking, restaking. Staking was actually the biggest one. And there was a question around whether or not, if the staking ratio keeps going up, today we're at 28%, but if that number goes up to 50% or 80%, what that might look like regarding, the profitability to our solo stakers, if that's something that we want. And so I think that there were some challenges to this kind of approach where, Ethereum is kind of comes out of this, bedrock of decentralization. They want to, maximize their staker and validator set. But then the reality is that, if capital comes in and some of these ETFs want to stake, $10 billion, it's very hard for you to scale up, with 100,000 new solo stakers or home stakers, right? That's not really an economics and incentives problem at that point. There's not really much you can do. And so I think one of the big discussions there was, should we lower the issuance curve and make staking less profitable? Otherwise, as you go further and further out on the curve, and Ethereum staking yield doesn't become real yield anymore, it just becomes becomes net inflationary even without the yield, then people might be forced to stake just so that they don't feel like they're missing out because of inflation. So they can enter this like negative spiral where just more and more people stake, and that just challenges more solo stakers, and then everything goes to these big players. The alternative solution to that was maybe focus on LSTs, focus less on just home stakers and more on like competing businesses where you have validators who are professionally run. They don't have to be huge players, but at least you have a very long tail of professionally run businesses. And that's something that you might see in like Solana or some of the Cosmos ecosystems where you can delegate your stake. But that would require a big overhaul to LSTs and enshrining this way to delegate stake. So there's a lot of challenges around there. And I feel like one of the big problems with Ethereum's direction is that Ethereum has an incredible talent pool of highly intelligent researchers and people, but they're all very focused on these problems that don't really materialize in terms of adoption. So how do you get more people using Ethereum? How do you get more people onboarded? Some of these challenges that a lot of people are spending time on aren't directly related to that.
So David, just two final quick questions. You mentioned LSTs. In the past, in other conferences, there's been risks around or concerns around LSTs and also the large amount of TVL going into certain protocols such as Athena. Did you hear anything about that, or were there any other risks that people were thinking through?
I don't think there were any new risks in terms of TVL. I think the biggest one actually was a discussion around restaking. And the question around restaking was more of, today rewards and slashing are not live on any of the big shared security or restaking protocols. And there's also a question of how sustainable the yield will be, given that we have about $15 billion, if not more, locked into these shared security protocols. How much real revenue would you need to generate to actually have a meaningful impact on the net restaking yield, right? If it's 0.1%, are people willing to take that slashing risk? Maybe a 2% people might be, but 0.1% or anything less than that, it's very hard to imagine underwriting that risk, especially when it's slashing risk and liquidity risk that you're dealing with. So I think that was a big one. Not so much on the concentration of liquid staking tokens. I think that's kind of part of the solo staking discussion that we just discussed. But there's nothing really new to that conversation that I felt like was discussed here outside of the restaking question.
Okay, cool. And a final question, versus other crypto conferences you've been to in terms of general mood and excitement and things like that, how did it feel?
I feel like some of the other crypto conferences, people leave like very bullish. I felt very, I didn't feel negative, by the way. I felt very neutral. And it felt like a very grounded conference where there was a very clear discussion around like, what are we doing well? What are we not doing well? And then there was a lot of emphasis on just kind of challenges and trying to work through that. So I think that in itself is promising, but it wasn't like, hey, we're all very euphoric. Everything's going to go great. People are recognizing that there are real challenges and also real competitors by other chains. So I think that was, a very grounded conference.
So it feels quite sober. I mean, developer conferences are always going to be a little more grounded, I think, as you said, versus some of the other ones. And for those that love the south of France, it sounds like the next one is in Cannes in 25. Is that right?
Yep, that's correct.
There you go. So I'm sure, hopefully, we'll avoid Lamborghinis and boats and all things like that. Okay, thank you so much, David. Great to be back. Appreciate your insights, and thank you so much to Josh, and our fantastic production team as well. And thank you for listening in. Have a great week, and we'll see you soon.